All right, welcome to The Explainer. Today, we're digging into a really fascinating investment thesis that presents a pretty big puzzle in the silver market. It's a story about numbers, powerful forces colliding, and a potential future that, according to the source, most people just aren't seeing yet.
So, to really get this, we've got to start with the core puzzle, the central contradiction that the source material lays out. You know, it's one of those situations where you have to hold two totally opposite ideas in your head at once, which is usually where the most interesting things happen.
And boom, this slide lays it out perfectly. On one side, you've got the price, trading around $76 an ounce, which, let's be honest, is way down from its peak. But then you look at the other side, the physical reality, and it's telling a completely different story. We're talking about a confirmed structural shortage, a deficit that's actually getting worse, not better.
So, that's the big question, right? How in the world do you connect that low paper price to a potential $300 target? What's the logic here?
Well, that's exactly the math we're going to unpack today.
The argument kicks things off by painting a picture of what the source calls a pressure cooker environment. And this isn't about just one thing going on. It's about a bunch of huge, powerful forces all converging at the exact same time.
And here's where it gets really interesting. Look at these three forces all slamming together. First, you've got macro uncertainty. The Fed is in a tough spot right at the moment. They need to make huge calls on interest rates. Then, you've got this geopolitical mess, a stalemate that's keeping oil prices jacked up and everyone worried about inflation. And holding it all together, you've got that physical deficit in silver itself, which we will definitely get more into. Okay, so let's keep building this out. To really grasp this thesis, you have to understand that there are two totally different silver markets. They're connected for sure, but right now they're telling two very different stories.
So the argument here is that most of us, we only see what's on the left, the paper market. That's the price you see on the news, the one on exchanges like COMEX, and it's driven by, algorithms, traders, and what they think is going to happen with interest rates. But what we're missing is the story on the right, the physical market. This is about actual metal, coming out of the ground and being used in industries or turned into bars and coins. And check out this number, 46.3 million ounces. That really drives the point home. This isn't just a guess. This is from the World Silver Survey, basically the gold standard for silver data. They're confirming the physical deficit is going to widen to that number this year. Now, that metal has to come from somewhere, right? And it's being pulled from stockpiles that are already getting pretty thin.
And look, this physical squeeze isn't something new. The source points out that just earlier this year, the amount of silver available for delivery on the COMEX, the real stuff, it dropped by 31% in just a few months. That's not some paper trading quirk. That's a sign of real physical tightness.
So you might be wondering, why is silver so notoriously volatile? Why these crazy price swings? Well, the source uses this great analogy. It says the silver market isn't a swimming pool, it's a bathtub. The whole market is only about $150 billion, which sounds like a lot, but in the grand scheme of global finance, it's tiny. So when even a small amount of money, a rock, moves in from, say, the giant ocean of the bond market, it creates these massive waves. That volatility isn't a bug, it's a feature of its size.
Okay, so we've got the pressure cooker, we've got the two markets. Now let's get to the core of it. Part 3, the framework for 300. And the source doesn't just pull this number out of thin air, it's built with a really logical, layered approach.
So the whole idea is built on these 3 layers, and each one builds on the last. And here's the key thing to remember. None of this requires some crazy black swan event to happen. It's all based on things that have happened before or are, kind of already happening now.
All right, layer 1. This is just straight up math. Let's forget about the supply squeeze for a second. If you just take what the big banks are forecasting for gold, and you assume the gold to silver ratio just goes back to its normal historical average, you get a silver price somewhere between $101 and $150. That's not a wild prediction, it's just a return to normal.
Okay, but layers 2 and 3, this is where the fireworks happen. The source argues that when you get a big shift from the Fed, a pivot, and people start losing faith in currencies, and you slam that into an already super tight physical market, you don't just get a nice, steady rally. Nope, you get what the source calls a violent repricing event.
Of course, no thesis is complete without looking at the risks, right? We have to be honest here. And the source is super clear about what could totally kill this whole scenario.
And here they are, the bull case killers. First, a real comprehensive peace deal in the Middle East. If that happens and the Strait of Hormuz opens up, inflation could cool off and the Fed gets a lot more breathing room. Second, some kind of crazy tech breakthrough.
Imagine if solar or EV companies figured out how to get silver out of their products completely. That would be a huge hit to demand. And finally, a nasty global recession. That would just crush industrial demand, which, remember, is like 60% of all silver consumption. So yeah, these are the real-world things to watch out for.
And the key takeaway here is that this isn't some maybe in 10 years kind of thing. There are key events happening right now that could be the catalyst. We're talking about economic data this week, what happens with the Fed's leadership, and of course the whole geopolitical situation. These are live triggers.
So when you weigh everything, the bull case, the bear case, what's happening on the ground right now, the source lands on this really powerful statement. It's basically saying, look, we don't know the exact timing, and it's going to be a bumpy ride, but the fundamental math, the supply, the demand, the monetary policy, it's all pointing in one direction. And that direction is not $76.
And that's what this all boils down to. The source leaves us with this final, really thought-provoking question. It's all about timing and conviction, isn't it? After seeing all the math, all the potential triggers, you're left to ask yourself, are you early or are you just waiting for confirmation? And maybe, more importantly, in a market moving this fast, what does confirmation even look like? And at what price does it finally show up?